If you're looking to grow your small trading account safely using options but don't have a lot of capital, you're in the right place. The markets have been on an absolute tear recently, and I found a lot of success trading this strategy. Today, we're diving deep into the call credit spread strategy, a powerful, defined risk way to generate consistent income if you have limited capital. In this video, I'll break down exactly how the strategy works, why it's perfect for small accounts, and how to manage your trade for steady growth. Hi, my name is Gautam, and on this channel, I talk about the stock market and achieving financial freedom with the power of options trading. So if you enjoy content that can help you retire early and achieve financial freedom, don't forget to hit the like button, subscribe to my channel, and share this video with your friends and family. Also, if you are new to the options world or are simply looking for one-on-one guidance to help you shortcut years of trial and error and avoid costly mistakes, click on the coaching link below and I'll be honored to help you out. With that said, let's jump right in and get started. A quick disclaimer before we get started. I'm not a licensed financial advisor and I'm simply showing you my trades and how I trade. This video should be used for educational and informational purposes only. Having said that, let's understand what credit spreads are. So, a credit spread is an option strategy that collects premium upfront by selling one option and buying another option further out of the money on the same underlying stock or ETF and the same expiration. You profit when the spread expires worthless, meaning it stays above or below certain price levels. Let's dive into the call credit spread in much more detail. So with the call credit spread, you sell a call option at a lower strike price and simultaneously buy another call option at a higher strike price. Both options have the same expiration and are traded on the same underlying stock or ETF. The goal of this strategy is for the price of the stock or the ETF that you opened up the spread on to stay below the short call at expiration. And in that case, both options expire worthless and you get to pocket 100% of your premium. Let's talk about when would be a good time to open a call credit spread. It would be a good time to open a call credit spread when you believe that the price of the stock or the ETF will either continue to stay at the same levels that it's currently trading at, or will go down, or will not exceed the price of the short call that you've sold, which is the lower strike price. Let's look at an example on SPX. Assuming SPX is currently trading at 6,000, you would sell a 6035 call for $9. At the same time, you would buy a 6040 call for $8, and in return, you would collect a premium of $1, which if you times it by 100 shares, that would be $100. Now, all you need is for XPX to stay below 635 at expiration, and in that case, you get to pocket the entire premium. Let's look at some entry rules and exit rules for this strategy. For the entry rules, the ideal scenario would be when the VIX is trading at or below 20. Not saying that you can't trade when VIX is higher than 20, but that just means more volatility, and you just need to know how to manage the trade in that case. Second, if you're doing this as a zero DTE trade, you want to choose a day when there are no major planned news events like the CPI, Fed data, announcements, etc. The ideal time to open this trade would be about 30 minutes to an hour after the market open when you see clear market direction. Since in this case, we're only interested in the call credit spreads, so I'd be interested at looking at the top, which is a resistance, and open up my call credit spread, few strike prices above that resistance level. For exiting the trade, you can obviously exit the trade anytime you like, but generally I like to set profit targets of anywhere from 50 to 75% of the initial premium that you collected. If you have strong conviction that the price of the stock will not reach close to your sold strike price, which is the lower strike price of the spread, then in that case, you can let the spread expire worthless and collect 100% of the premium. In case the trade starts going against you, I also like to set a stop loss of 2x the premium that you've collected. So in this case, let's just assume that we collected $45 in premium for opening up this spread. So your stop loss would be when the trade goes negative $90. Or you can simply cut the trade when it starts approaching lower strike price of the credit spread. Next, let's do a trade example on SPY and see how we would build a call credit spread. So I have the SPY 6-month chart pulled up right here. And as you can see, SPY is currently at the top of its Bollinger Band For those not familiar with the Bollinger Bands, the Bollinger Bands are a technical analysis tool that I like to use for my trading. It simply means that the stock generally tends to remain 95% of the times within the Bollinger Bands, the top, middle, and the bottom. And in cases where it pops out of the Bollinger Band, it quickly reverts back. So looking at where SPY is trading at right now, it's at the top of its Bollinger Band. Now, there's no saying that it cannot continue to keep going higher, but considering that it's at the top of the Bollinger Band, I do believe that there is a possibility of a pullback, even if it's a small pullback this week. So given that, I'm confident that if I open a call credit spread on SPY for the upcoming week, that there is a strong possibility that I would end up the trade in full profit. So looking at where SPY is at right now, it's around the $625 level. So let's pull up the options chain for this upcoming week. And I'm going to go to the options chain and I'm going to go out to the July 11th, which is this upcoming Friday. A lot of people say that, hey, we've lost a lot of money trading call credit spreads or put credit spreads, whatever it may be. So the way to make a successful trade with the spreads is that you want to choose a low delta. And what that means is that you're not going to collect a lot of premium, but you can make up for that by adding more contracts. So if you were to open one contract that would offer a higher premium if you went with a delta of 15 or higher, instead, you can go with a lower delta of 10 or 11 and open up two contracts because I believe in that case that you have higher chances of success. So looking at where SPY is at currently, it's at the 625 level. So Thinkorswim shows right here that there is a possibility of about a $9.49 move plus or minus from the current price by July 11th. Since we're selling call credit spreads, I'm going to add this 9 or 10 bucks to the current price. So if I add 10 bucks to the current price of 625, that would make it $635. So if I look at the delta for the 635 strike price, that's a 16 delta. Now I want to be even safer and I can go out to the next strike price. I think there's something funky with this options chain because if we look at the 635 strike price, it's actually a delta of 16 and then it drops to a delta of 5 right after that, the 640 strike price. So I'm going to go out to the next options chain, which is July 14th, 9 days out, just for an example. And hopefully this options chain is probably going to look better and is not messed up. Yeah, I think this one looks good because we go from a delta of 17 to 14 to 12. So looking at the expected move for July 14th, which is 9 days out, the market's pricing a move of about $11 or $10.78. So let's build the call credit spread with our short strike price being the 635 strike price, just like we said. So to sell an options contract, you have to click on the bid right here. So I'm going to go ahead with this bid right here. And as you can see, we're selling one 635 call option. And to build the call credit spread, we have to buy another options contract. I generally like to go 5 strike prices out, which is a width of 5 points. So in this case, I'm going to go to the 640 strike price and I'm going to click on the ask. And when you click on the ask, it's actually going to buy the position. So as you can see, we're selling one 635 call and we're buying back one 640 call. That's a width of about 5 points. And for opening this position, you would get a credit of 78 cents or times 100 shares is $78. Now, I said earlier that if you want a higher success rate for your call credit spread, to go with a lower delta, and that's what I like. So let's go ahead and change this and see what happens in that case. I'm going to go with a lower delta of 12, which is the 638 strike price. I'm going to click on the bid to open up the call credit spread, and we're selling this 638 strike price call option. And since I generally like to go with a spread of 5 points, if we add 5 points to the 638 strike price, that would be a strike price of 643. Now the options chain currently not showing a strike price of 643 because I guess it's far out. So I'm just going to go ahead with the 645 strike price and click on the ask because we're buying this. So let's assume that if we actually had the 643 strike price, that this would cost us a bit more, maybe 15 cents. So right now you're getting 49 cents to open up this trade. And let's assume that this was 15 cents. So, that would be more like 44 cents if we had a 43 strike price. So basically you went from with a higher delta collecting $78 in premium versus $45 or $44 in premium, But I do believe that going with the lower delta, you have higher chances of success. And in the long run, you can successfully grow your account if you stick with the lower delta. So let's look at the P&L chart now and see what would need to happen for this trade to be successful. So as you can see, SPY is currently trading at 625. The short call that we sold was with the 638 strike price. So all we need for SPY to do is stay below the 638 strike price, and we would pocket 100% of the premium that we collected when we opened the trade. Now, if I see that SPY is getting close to this red zone, close to my expiration, I would exit the trade right there. My other criteria for exiting the trade is that when your loss is 2x the amount of the premium collected. So, for example, if you collected $45 premium when you opened the trade and you see that you're currently in a loss of $90, which is 2x the premium that you collected, then I would exit the trade at that point. So that's my strategy for building a small account safely and consistently with call credit spreads. Now, one other thing I mentioned early on in the video is that the credit spreads come with a defined risk before you go in the trade. So if you open up a credit spread with a $5 width, your max loss would be $500. And if you open up a credit spread with a $10 width, that's $1,000. So keep that in mind when you open up a credit spread, and only risk the amount that you can afford to lose. So that's it for this video. If you enjoyed it and learned anything useful, please be sure to give it a thumbs up, subscribe to my channel, and leave your comments below with any thoughts or feedback. If you'd like one-on-one coaching directly with me, click on the first link in the description below, and I'd love to help you out.